Welcome back. Question. Does it feel like the economy is sending mixed messages? Well, if so, there's a reason why. We're going to take a look at some of the news of the day to try to understand why this is happening. First, the good news. Washington Examiner reports housing starts rose in December as mortgage rates remained elevated. The number of housing starts ticked up in December despite pressure from high mortgage rates. A bit of good news for the economy. We can see, and this is on a month-over-month basis, the housing starts, which are considered a leading indicator. They indicate the housing projects that are, at the beginning part of the stage, are broken down into different categories. The blue bars represent the overall housing starts, yellow, 2 to 4 units. The red bars, single family units, and the green bars, 5 units or more. Well, in terms of the total units, we can see it was down 4.3% on a month-over-month basis. Housing starts for single-family units down 8.6, housing starts for 2 to 4 units up 23.1, and housing starts for 5 units or more. That's up 7.5, but that's on a month-over-month basis. Let's take a look at the yearly change, which is a lot more significant. Housing starts overall yearly up 8%. Housing starts for single-family units up 16%. Housing starts for 2 to 4 units up 78%. And those larger projects for housing starts 5 units or more down 10%. So overall, we see a tremendous amount of growth in most of the categories of housing starts. Now we see here housing starts single family units. Those are reflected by the bars. White line S&P 500. Today's number is the second best number, excluding last month, the second best number we've seen since late 22. Certainly room for optimism. We can take a look at the correlations to the S&P 500 within the different categories. Now, we took data going back to 2001, and we're trying to discover which category is most closely correlated to the S&P 500. Housing starts overall, 15% correlation. Correlations close to zero really mean there's no connection. Housing starts -3% for single family units. Housing starts for 2 to 4 units. That's a -40%. That's, a little bit more significant. But most significant, housing starts for 5 units or more. Those are the big projects, and it makes sense that would be most closely correlated with the economy and the stock market because, we don't enter into these large construction projects lightly. There's a lot of moving pieces. Well, housing starts for 5 units or more are reflected here with the bars and S&P 500 in white. And we can see when one line goes up, so does the other. So certainly a very strong correlation. Now the bad news. MarketWatch reports Philadelphia Fed factory gauge remains in negative territory for a fifth straight month. The Philly Fed said Thursday its gauge of regional business activity was reported at a level of negative 10.6. Any reading below zero indicates deteriorating conditions. This is the fifth straight month in negative territory and the 18th over the past 20 months in negative territory. Well, Philly Fed manufacturing survey is broken down into several categories. Negative numbers, by the way, indicate contracting conditions. General activity, that's the headline number, down to a level negative 10.6. Inventories, negative 14.6. Unfilled orders, 18.5 to the downside. New orders down to negative 17.9. And finally, delivery time, negative 27.6. The most significant moves and readings in the Philly Fed manufacturing survey are deep in negative territory. And by the way, if you recall earlier this week, we spoke about the Empire State manufacturing figure, which is certainly very negative as well. General activity is reflected here, white line S&P 500. That's at a level of negative 10.6. This is the fifth straight month in negative territory. The inventories are reflected here, negative 14.6, the worst number since the beginning of 23. New orders This is reflected here as negative 17.9, the second worst number going back to late 22. Unfilled orders, negative 18.5. This is the worst number going back to mid 22. Delivery time, the worst number we've seen in several years, down to a level negative 27.6. Certainly poor news for the manufacturing sector, and this really does confirm the Empire State Manufacturing number, which reflects manufacturing in New York states. Two bad numbers show us manufacturing has really fallen to the wayside. Now, the red line represents the Philly Fed general activity that we just spoke about. The green line represents the housing starts. Now, this is a chart that goes back to the 2008 financial recession. Notice in particular the divergence. Philly Fed was actually quite strong at that time. The housing starts were very weak, but there was a big disagreement. Of course, the housing starts were weak. The 2008 recession, in large part, was based around the housing market. So, but we can see there's a big divergence between the two. Fast forward to present day. Well, the bars represent the Philly Fed general activity, which in this case is now very weak. The housing starts on a year-over basis is quite strong. 8% to the upside year over year in the housing starts, negative 10.6 on the Philly Fed. So we see another divergence. Certainly not to the depths that we saw in the 2008 recession, but we can see going back several months, both of these numbers were in negative territory together, but now that's not the case. Well, what can we learn from all this? Number one, strong economies grow in most or all the sectors. You see, we're all sort of linked together. We may work in one sector, such as manufacturing, but when we choose to buy a house, that affects the housing market. If we buy a car, that affects the automotive market. So, really the economy is connected all together. And when one sector is weak, it can have an effect to other business areas. Now, if you recall, in 2008, the financial crisis caused damage in many of the sectors, the housing market, insurance, credit cards, auto industry as well. Currently, housing starts are improving, but the manufacturing is very, very weak. So this divergence between the two is certainly a cause for concern. And the mixed messages it sends shows us there's an uneven level of economic growth, which in of itself is really not a good sign. We want to see strong or moderate growth among all sectors so that the sector that we're employed in is strong, and then we can, go and buy a house that will affect another sector. So right now, even though we see strong numbers, the overall, I would say the state of affairs is that it's a weak economy because the weak sectors certainly are cause for concern for the strong ones. Moving forward, we'd like to see the weak sectors improve. And I think that really is going to tell us, what's in store for us in the future. Do the weak sectors improve or do the strong sectors start to come to the downside? And of course, we have the Federal Reserve and their pending interest rate cuts to contend with as well. As a reminder, if you have not already, please visit our brand new Substack newsletter, the current article, The Inverted Bond Market, Where Are We Now? We take a look at the state of the inverted bond market, how it's occurred in the past, for what reason, how did stock markets behave during that time, and really what happened afterwards. If you'd like to do so, please visit our Substack newsletter. It's absolutely free, no registration required. Just go to substack.com and very simply enter in just the data. Also, please visit our Twitter page for daily updates. We hope this has been helpful. We look forward to seeing you back soon.